Imagine you are a general, preparing for a war against a formidable enemy, the market. Your troops are your funds, ready to be deployed in the battlefield of investments. Just like in war, diversification is key. You wouldn't send all your infantry into battle without any cavalry, would you? Similarly, investing all your capital in a single high-leverage asset is like going to war with only one type of soldier. The risk is too high, and the potential for losses is great. On the other hand, fragmenting your investments too much is like scattering your troops across the battlefield. Yes, you have a presence everywhere, but it's so thin that it won't hold up against a concentrated attack. Managing a portfolio with too many small seed investments may be impractical, and the potential for significant returns in a market that thrives on active volatility might be limited. Now let's look at the types of stocks: growth, value, dividends, and cyclical stocks, as different types of troops. They each have their strengths and weaknesses, their roles and responsibilities, but they may not always complement each other. Just like a cavalry charge might not work in a dense forest, a high-growth tech stock might not fit well in a portfolio dominated by stable, dividend-paying utility stocks. Imagine deploying all your infantry to win a quick battle, only to find that the enemy has sent cavalry to flank you. If you had invested all your troops, you would have no reserves to save you in times of crisis. By diversifying and keeping some of your troops or funds in reserve, you're prepared for unexpected situations. To navigate the ever-changing market trends, flexible deployment of your seed capital, like your troops, is necessary. Just as a smart general keeps his troops ready for any scenario, a savvy investor keeps his funds allocated in a way that can adapt to market conditions. This doesn't mean spreading yourself too thin, but rather having a well-thought-out strategy that takes into account the risks and potential rewards of each investment. So, like a general on the battlefield, manage your investments wisely and be prepared for whatever the market throws your way. Just like a general managing an army, managing your portfolio requires strategy and foresight. How you deploy your troops, or in this case your assets, can make the difference between victory and defeat on the battlefield of finance. Let's consider the number of stocks in your portfolio. Too few and you risk overwhelming losses if a single asset performs poorly. Too many and managing your portfolio becomes a Herculean task. A manageable number, around 3 to 5 stocks, is akin to limiting the types of troops in your army. It's a balance that allows for both manageable oversight and necessary diversification. Think of it this way. If you were a general deploying all your infantry to quickly win a battle, but the enemy sends cavalry to capture you, what would happen? You'd be in a tight spot, wouldn't you? The same goes for your investments. If you put all your eggs in one basket, you leave yourself vulnerable to massive losses with no backup plan. This is where the concept of structured reserves comes into play. By allocating only 50% of your total seed to cover various scenarios, you have a safety net. During market downturns, like the Nasdaq downturn at the beginning of the year, having these reserves becomes crucial. The remaining 50% can be used to support growth stocks, hedge by investing in alternative assets, or explore emerging technologies with high growth potential. Let's not forget the importance of diversifying your investments according to the nature and risk level of each stock. High leverage stocks carry significant risks, so they should receive smaller seed portions, while lower leverage stocks may allow for larger seed allocations. In conclusion, managing your portfolio is much like commanding an army. It requires strategy, foresight, and a keen understanding of the battlefield. By limiting your seed capital, you create a reserve force to address risks during crises. This strategic move not only safeguards your investments, but also opens up opportunities for greater overall profitability. Remember, by limiting seed capital, you create a reserve force to address risks during crises, potentially leading to greater overall profitability. Just as a battlefield is unpredictable, so is the market. Stock prices are like flags in the wind, swaying to the rhythm of market expectations. These expectations, fueled by speculation and outlooks, can push stocks into overbought or oversold conditions, regardless of a company's intrinsic value. Think of an oversold stock as an enemy caught off guard. It may seem like the perfect time to strike, but be careful. The market might still view it as overbought. However, you've prepared for this. Remember your reserve force. With only half your seed in the game, you've got the other half ready to buy in stages. This approach lowers your average cost and spreads your risk. As the market reacts and capital flows into these oversold stocks, they may soon find themselves in overbought territory. And that's where you can strike a decisive blow. By using your reserve force wisely and taking advantage of market volatility, you can emerge victorious in the war against the market.